second half of the day. On the subject of global growth, though, especially for equity markets, here is an exclusive conversation with Warren Buffett and how he sees the year panning out, especially for the US markets and the impact all over the world.
The sequester, in effect, reduces the amount of stimulus to the economy. I mean, they talk about stimulus and they say, well, this is a stimulus bill, you know, and they vote 800 million or something, 800 billion, and say, well, this is stimulus. Stimulus is when the government operates at a significant deficit. That is stimulus by Keynes's definition. We're operating at $1 trillion deficit, roughly. The sequester reduces that a little bit. Raising the taxes at the start of the year reduces that somewhat. But we're still operating at a deficit that is 6% of GDP. And by Keynes's definition, in the fourth year of a recovery, that's a pretty fair amount of stimulus. So it has the effect of reducing stimulus.
But it sounds like you think that's a good thing at this point.
Well, I think at some point reducing stimulus is good. And I don't think a 6% stimulus in the third to fourth year of a recovery, that is recovering. I think that's still giving the economy quite a juice.
So you're not worried about the sequester and about this pulling back in the economy, because there have been a lot of scare tactics out there. There have been a lot of people who have said this is the end of days if we get to this point. You don't think that's the case?
We're going to bring down spending and we're going to bring up revenues. And we may get there in fits and starts and everybody may scream each time we do it. But the deficit is going to come down, and it needs to come down, and it will come down. And we may be doing it in a meat-axe way in this particular move. We did it in kind of a meat-axe way in terms of the revenues going up. At the start of the year, when we increased the payroll tax by a couple percent, that hit all across the board, you know, on poor people and people of moderate means. It was a lot of money. It was roughly an equal amount to the sequester, incidentally. So we cut the stimulus from these two factors, but it's still 6% of GDP. And if you'd asked me 3 or 4 years ago whether having running deficits of 6% after a recovery that's been going on for 3 years was appropriate, I would say that's a fair amount of stimulus.
So is getting there in a meat-axe way better than not getting there at all?
That's a good question. It probably leads you to getting there at all. You may have to use the meat axe first, and then people kind of look at their handiwork and say, we have to do better than this. But, you know, we still are talking about spending $3.6 trillion and taking in $2.6 trillion, and that's a lot of stimulus.
Okay. Joe, I know you have some questions as well.
Well, yeah, I mean, that just, when Warren talks about where we are and that we are recovering, I mean, you'd have to extrapolate what you said to Ben Bernanke and the Fed, I guess, too, Warren. I mean, awfully stimulative at the Federal Reserve, and I guess I would, just reading between the lines of what you said, I guess you'd wonder whether they need to be quite as free and easy right now, too.
Yeah, it's an interesting thing, Joe, because we're running, we'll say, very roughly $1 trillion deficit, and the Fed is buying roughly $1 trillion worth of, and not necessarily government bonds, but mortgages, but government-issued paper, or let's regard it as government paper. And so, in effect, they are picking up our deficit and creating bank reserves with the money. And you might say, you look at that and you say, well, this is wonderful. You might say, why don't you have them buy $3.6 trillion of government paper every year, and then there wouldn't be any necessary, you wouldn't have to have any taxes, and the Treasury would be running or the Fed would be running a huge profit. Then they're running about $80 billion a year now, but now they'd have this wonderful carry. You know, that $3 trillion of assets that they have are financed about a little over $1 trillion by currency in circulation. Well, that doesn't cost them anything except the cost of the paper. And then they've got a couple trillion, or close to it, of bank reserves, which cost them 1/4%. So basically, you know, I'm jealous of the Fed. I'd like to have a machine like that myself. But it doesn't cost them anything. So if they can do $1 trillion this way, why not do $3.5 trillion, and then we wouldn't have to have any taxes at all.
You're being facetious for anybody who may not be picking up on this.
Yeah, no, I am being facetious, believe me. But it's something that can't go on. And if it was this easy, you know, we were doing it centuries ago. And I've got enormous respect for Chairman Bernanke. I think what he did in the fall of 2008 saved this country. But I think it'll be interesting when they get to the unwinding stage of a balance sheet. It's usually a lot easier to buy things than to sell things. I found that in my own job.
He said, I think it will be interesting when they get to the unwinding stage of the Fed's balance sheet. When you say interesting, what do you mean? And I say that because you called 2008 interesting, too.
Yeah, that's a euphemism. It's very easy to buy. You've got the Treasury issuing securities like crazy, and you just sop them up. You know, if you buy $85 billion a month, and you just credit bank reserves. The Fed has about $1.1 trillion or something like that of currency in circulation. You could just put more currency in circulation, but basically you credit bank reserves so that if you're going to have $3 trillion of assets, you need to create $1.8 trillion or $1.9 trillion of bank reserves. And they pile up, and the bank's got 0.25% on it, and they don't like it because they're losing money, but they don't have good places to put out a lot of money now. Now, when you start selling, you know, at that point, you start sopping up reserves, and that's a much different action than buying. You saw just the whiff about, I don't know, 2 or 3 weeks ago, just the whiff of the fact they might start tightening up, and the effect that has on the stock market. All over the world, everybody that manages money is waiting to catch the signal that the Fed will reverse course. And you know, I think they're on a hair trigger. So I think the Fed will try to give little signals here and all of that. But in the end, there are an awful lot of people that want to get out of a lot of assets if they think the Fed is going to tighten a lot. And we've never quite had, at least to my knowledge, we've never had the degree of disgorgement that might be called for down the line. And who knows how it will play out. But it'll be noticeable. I'll put it that way. It'll be very noticeable.
I know you don't pay attention normally to where the stock prices are, but you did write that op-ed back when you thought stock prices were very low.
Yep.
When you look at where the indices are now, which is right near all-time highs, does it make you nervous? Does it make you less likely to go out and say buy, buy, buy in terms of the stocks that you're adding to your portfolio?
Anything I bought at 80 I don't like as well at 100. But if you ask me whether stocks are cheaper than other forms of investment, in my view, the answer is yes. We are buying stocks now but we're buying them not because we expect them to go up. We're buying them because we think we're getting good value for them